Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy. Today we're going to break down 3 of Nasdaq 100 income ETF funds to really find out which one is the best for a retirement account, where you want to place each one of these, because they're all the same, but they're all different. You ever hear that one? They're all the same, but they're different. We want to break this down and show you the strategies that each one uses. How does it differ from the other one? Who's the strongest? Who's the weakest? And we're going to put a whole nice package together to show you where this would fit in all of your portfolios. But before we get into that, got to do a shout out to all of our Patreon supporters and all of our YouTube subscribers. Thank you all for joining the family. I really feel like this is a giant family that we deal with, and I'm just helping you out down the path of financial freedom. Hey, before we talk any farther, I got to shout out. You guys know, I'm just telling you straight out, I have the brand new cup, the Retirement Easy on Dividends, off of dividends. It's our new mug. We're actually in the second production already. I can't believe how many people have jumped on and ordered a cup. I'll put a link down below. We're making it even easier. You can directly go right to a website that is supporting us and helping us. And you can buy directly from there. Or you can go right into Patreon and order one on Patreon, and we'll get those mugs right out to you. It helps. It's something minor, something minute, but it does help the channel. Every little bit helps to keep the stuff rolling. Let's get into today's video. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So let's start off with how we did our comparisons. I want to show you that we don't just pick one or the other and say, hey, this is the best. What we do here is we first off take a look at the strategy. How is the fund actually generating its income? 2, what income are they generating? What yields are coming out of it? And remember, on this channel, we don't yield chase, but you got to take a first look at the yield. We also then want to look at the growth history of the fund, because you need growth in retirement. No matter what anyone says, you do need growth. Then we're going to look at number 4, which I think to me is one of the most important ones. And maybe they should move it up to number 1, but that is total return. Total return will tell us more about the fund than anything above it, all because it tells us if the fund's healthy or not. And then number 5, that tax profile. We'll break down the tax side of it, because you can earn all the money you want, but if you don't keep it, if you have to give it to the tax man, you're just working for old Uncle Sam. So how all these will fit into a retirement portfolio, well, that's the big struggle, and that's the big chance, and that's what a lot of people have asked us about. That's why we built this, so we can all get into that financial freedom down the road. So our first fund we're going to talk about, GPIQ, the Goldman Sachs Nasdaq 100 Premium Income ETF. Now their strategy is a dynamic call writing overlay of the Nasdaq 100 holdings. It adjusts coverage based on market conditions and volatility. The balances income generation from the upside participation. So basically what they do, and I'll put it in I always call it my layman terms, keep it kind of a simple way. The unique thing what GPIQ does is they don't open everything up. They don't go 100% covered call and caps their upside. What they do is anywhere between 25 to 75% of the portfolio is covered, is they put it out there. In good times, they actually will be lower. They'll probably only be at 25%. In bad times, they'll go to 75. The reason for that is they want growth and income. And there's a reason why you say growth and income, because they're looking to get as much growth as they possibly can from the fund to grow it out and then add on additional income. So they're always, like I said, they're doing that dynamic cover call writing. They're only using portions of the holdings that they have. They're not going out full market. The yield, we're looking at between a 9 to 10%. So it's pretty much, on the low end across the board in covered call ETFs. Now, they do use a lower yield because they do use a stronger growth participation. Remember I said growth over income. So growth participation is that dynamic overlay avoids the full coverage. It preserves the meaningful upside in the Nasdaq bull markets. Now, total return. Total return on this is in the low 30s, about 1 year total return, including dividends. So it's an impressive, but not an income-focused ETF. And then the tax filings, which we'll cover all of these deeper involved, but these are the highlights of GPIQ. They're taxed. It may include some capital return of capital, which we've talked about. I've done a video on. We'll link that down below so that you understand that we've done that video before. And return of capital is a good thing and a bad thing, or could be a bad thing. So it basically takes that tax deferred until you basically sell your shares off down the road. This is very much a balanced Nasdaq income ETF with income, growth, and a solid return. When we pop the hood, we'll go through this fairly quickly, but we pop the hood, they're already at $4.62 billion in net assets. It came out in October of 2023, so we're just basically about 2.5 years so far, I'll say, into the market. Dividend, like I said, is 9.68%. And the growth rate, 17.74% over the past 12 months. Total return, 31.67. So it has a solid assets of over $4 billion, has a number of shares, over 81 million shares outstanding, and it's been basically in that 57 to 58 price range. So it fits everything that I always talk about in ETFs. Liquidity because of the money and the assets, gives you a nice yield, nice growth. Now we get what I call the retirement income workhorse, QQQI. NEOS Nasdaq 100 high income ETF. The strategy, again, another unique strategy. The NDX index, which is the Nasdaq 100 index option overlay. So it's on the Nasdaq 100 exposure. Now, this is a data-driven call writing with active tax loss harvesting built in. It's not a basic cover call fund, as so many people think this is. It's an engineered for high monthly income while capitalizing on selective upside. Now, when you break this fund down, they actually buy the entire Nasdaq 100 as shares. So they have a full investment over 100 plus actual stocks and companies that they've bought into. But then, and they use that for the upside side of it. But then they go out and buy and sell NDX index options. Okay, and that's what gives you that call data writing. They do this to get your yields up to over 14%. Okay, now it pays larger monthly paychecks. But the thing is, the growth trade-off. The higher income triggers and targets is all by those option premiums. It gives some upside, powerful Nasdaq bull markets, but it really is designed for income first. So I showed you two funds so far. One is designed for growth. One is designed for income. Now, this one also uses a huge tax advantage. But again, we're going to break that down. Section 1256, which is a 60-40 split in law and capital gain treatments. So this one's going to be best for taxable retirement accounts that want income first investors who want a clear, structured, tax efficiency story of a single month across the board. When we break this one down, assets, $12.45 billion. So we're not talking about any small funds here. Expense ratio is 0.68. 228 million shares outstanding, 13.96% yield. So you can see we're seriously talking about some heavy yield in place. Now the growth, we talked about the growth side of it. Not as strong as we've seen before because it doesn't build for growth. It's working for income, and the growth is only from the Nasdaq itself having some growth, about 6%. Total return, 24.04%. So you can see how the funds really are different in adjusting. Now our third fund, TDAQ. It's a Tap Alpha Innovation 100 Growth and Daily Income ETF. Now I'm going to stop right here and clarify this. So many people think this one's going to pay a daily dividend. Wrong. What it is, the daily part of it, is they are doing daily 0 DTE, which is the strategy across the board. It owns the Nasdaq 100 via QQQM. It writes 0-day to expiration call options daily. It harvests rapid time decay in each session, and it resets its entire option strategy every trading day. So think about that. Tap Alpha is sitting here saying, what do we think the day is going to happen? Is it going to be a down day? Is it going to be an up day? They are able to adjust every single day to market conditions. Unlike GPIQ or QQQI, the full reset daily, while the other ones are doing primarily monthly. Now this one's going to give you income. This is going to be our highest yielding fund at almost 17% in distributions. Okay. Now the track record, I have to say, is caution, because this fund only came out in September of 25. So we're not even a full year into it. But there's so much talk about the fund and how the future looks on this fund that Tap Alpha is really kind of becoming the new king. But there's limited history across market cycles, which is what I get nervous about, and the tax profile based on early 19A estimates only. So it's a strong early results, but unproven in downward trends. So we use this as a satellite, not a core position, because we don't have enough data to say this is a core. We use it as what we call a satellite. But I want to make sure we put this into the challenge, because I believe TDAQ could be a solution to a lot of people's questions in their portfolios. So this one's going to give you the highest income. It's going to give you the innovation of a new, different approach of those daily adjusted 0 DTEs. But that short track record is what I always put out there is watch and be careful. So when we take a look at this one, now this is what I talk about. Assets, $227 million versus the $1 billion that we're talking about the other two funds. Expense ratio, 0.83. It's definitely going to be higher because that they're doing those adjustments on a daily basis. There's 8.48 million shares outstanding. It's paid about a $12.30 distribution yield so far. So we don't have a full year onto it. Remember that. So those numbers are really cranking out though. This one came out September 4th of 2025. And you can see the pricing. We've had as low as $22 all the way up to $29, and it's been playing right around that $27 range. So we're taking the snapshot that we have up to date, 12.30% yield, 9.42% growth, and a total return of 13.82%. So now let's do the comparisons against these guys. Now that you know that each underlying stock and each underlying ETF that plays into the game, first we're going to take a look at yield. Now, on the surface, if any of you out there are sitting there saying, yield, I want income. If you didn't build your portfolio properly, well, here's what I'm showing you. That TDAQ is the number one fund, looking between that 16 to 17% in the distribution rate using those 0 DT option strategy. It's the highest one in the field. QQQI gives you that retirement workhorse I've talked about, where it sells those NDX index options, and you're coming in between 13 to 14% in the distribution rate. And then number 3, GPIQ, the Goldman Sachs premium income, is still in that range of between that 9 to 10% distribution rate. Now, I always say this is a balanced approach, and it uses a dynamic call writing and growth and income option. So when we go through these, if you want all yield, TDAQ is the way to go. If you want that right down the middle of the game plan, QQQI is right there, and GPIQ follows up. But now we let's throw the growth into it. The page really changes at this point. GPIQ comes in at 17% growth rate. Okay, and TDAQ comes in at 9.42. Now remember, that's not a full year yet. And then we get into QQQI coming in around 6%. So when you have the number one fund, GPIQ, who is dialed into growth, and then add in a 9% dividend, man, that thing can look very impressive. When you take the TDAQ, that's giving you huge income, and then backing it up with about a 9% growth, another strong player in the market. Now, QQQI, totally different player. Solid down the road income. And then we're also taking a look at distributions are around that 6%. So that's that growth side of it. Put those together, you still got a strong total market, but you can see how the other two competitors are really starting to win the race. Now let's get into what I classify as my favorite category, total returns. How each fund captures the Nasdaq 100 upside and what does it really cost? Well, in this, you can see GPIQ, hands down across the board, wins the total return race, 31.67%. This is your growth plus your dividends all tied in together off the period of time that kind of what we take the snapshot of. It's got that dynamic overlay, not fully covered, which gives it a huge growth side of it. Most of the upside participation of the three. Income and the growth in balanced form. So it kind of wins the total return race across the board. QQQI actually comes in second place. And I'll say this is because TDAQ has not had that full year. 24.04% total return. The distribution and the trailing 12 months across the board added in. Now this one gives you the little higher income than GPIQ. So there's more premium sold. And it trades on the upside for monthly paychecks and a strong year-to-date return despite the income first design. So if you're really looking at income first, QQQI of course would be right there. GPIQ is giving you the growth edge. Now TDAQ, this one again, on this chart as we look, we talked earlier, it hasn't had that full year. So I know you're sitting there saying, well, it's not really a true comparison. But in just 9 months of being out there, TDAQ has generated 13.82% in total return. Using the daily 0T options, you've seen where it was able to reset itself on every session, and it's generating that 16 to 17% setup for 12 months. So in 12 months, it has 16 to 17% in this return side. That will definitely put it above QQQI. So that strong early results since September, but it's very limited track record, and it just needs more history. But I think this is the biggest one that gets talked about. I think it's right down the path that this one could do it. Now, if a fund pays 15%, but the NAV falls off 20%, is that really income? That's why total return becomes so critical. If TDAQ can promote 17% and come back with a 9% growth and tell me that you're getting a 30% total return, then I'm all for it. But if they're paying 17%, and I'm just using this example, if they're getting 17% yield and their total return is only 13, that means they're losing 4%. That means you're not getting the full 17, guys. So that's why we always want to watch total returns. This tells you what's going on. And looking at it right off the bat with just total returns, GPIQ is right there doing what it needs to do. Now, tax efficiencies. This game here, I can tell you, if you are in a Roth fund or an IRA, you're probably not as much concerned with this because your portfolio is being handled by the IRA and the Roth side of it. But as you go down the road and you start putting things into a tax brokerage account, which most people will, you start playing into this game. And this is the taxes. QQQI, even though it's in the middle of the page, I've kind of put it there for a reason. They are the strongest tax efficiency ETF fund out there. This is the second reason why QQQI is so strong in retirement accounts. Okay? They have right in the middle of the road, great income, designed for income. They have a system to get you some growth, enough to get you over the inflation rate. But then they come back and say, now how much money can you keep in your pockets? Because of the Section 1256 contracts using the NDX index option, your distributions are going to come to you first at 60-40 capital gains, which is 60% long-term, no matter how long you held it, 40% short-term. And when you look at the capital gains on things, you know there's three brackets of capital gains. There's a 0%, 10%, 15%. So a lot of your funds will fall right into the zero tax category. Now they're also going to use some active tax loss harvesting. Okay, so they're systematically managers the harvesting opportunities. And what is tax harvesting? Well, if they have a particular fund that's lost some money, they can sell that off, take the tax advantage because you lost it, you sold at a loss, you got covered at negative loss with other funds, turn around and rebuy it back if they want. So they're harvesting tax issues to lower the taxing side of it. Then on top of all that, they use a return of capital. As I told you earlier, return of capital is a positive and a negative. If used right, it's a very, very powerful tool. If you use it, as a lot of weekly ETFs have done, that they are now allowed to keep their distributions up and your return of capital, it's not used properly. And that's where you start to see the NAV erosions. Well, these guys here use it properly. You know, they're just covering every base they can to lower your tax bill to a T. Now, GPIQ. Now, this has a moderate tax efficiency. Primarily what they're using is that return of capital, which is taxes deferred until you sell or your cost basis get to zero. And hopefully by the time you get to zero, realistically, you would have held it long term and you'd be taxed in that basically long term capital gain side of it. Now, this one here, this is a lot of people throw them for a loop because GPIQ, Goldman Sachs, actually has some Section 1256 coverage. Okay, but it's not built around the 1256 contracts like QQQI is. But there are areas where they do qualify in certain select areas. So it's very less structured, but it's still there helping them down the road. So again, as we talked about this fund being growth oriented and QQI is income oriented, same thing in the tax side of it. They're more focused on return of capital, while QQI is more considered on the 1256 contracts. So it's a dynamic strategy that they use. The ROC defers the possibility, but the tax story is less defined. It's good, but it's not the tax leader. So I'm not saying it's a bad system. It's a good system. QQI just blows it away with what they do. Now, TAP Alpha, the TDAQ, I'm going to say this is promising. They do use a large ROC percentage currently, but remember, those are just estimates. You don't know what your true ROC numbers are until you receive your 1099 dividend sheet at the end of the year. Okay? So the full tax year is needed to confirm what that 1099 classification will be. And we're going to watch the NAV carefully. High yield ROC is good only if the total return holds up. Kind of what I was telling you earlier, that if they use too much ROC and it hurts and it cuts in the NAV, then we're going to see that in the total return report. And we know TAP Alpha was not going to be as strong. So the key principle here, high ROC is a tax advantage only when the NAV is stable. Always verify your total return along with your distribution yield. Now you know why I always say total return means everything. So the strategic retirement, the framework. Well, this one comes down to is where you're at in retirement. You want a balanced approach, income and growth as a balanced approach. GPIQ fits that bill very, very well. It's that monthly income with the strong growth room. The dynamic option overlay, not fully capped. It's best for income plus upside potential. Now the core holding, this is where I put it in my core category, is QQQI. High monthly income with that tax efficiency edge. Those 1256 do pay off at the end of the year. It's best for that taxable retirement accounts. So if you're doing a tax brokerage account, I think the 1256 contracts do everything. QQQI better be in your retirement package for sure. And then backed up with GPIQ as a bonus. And then I'll call it the satellite play. And that is the TAP Alpha. It's the highest yield. So if you're sitting there saying, I need income, you want TDAQ, okay? But you don't want it as 100% as your total portfolio. The reason for it is it's not been there long enough, not been tested. You need to have a backup plan, which I would be TDAQ in my book as income using QQQI or GPIQ as your backup to give you some growth across the board. So a limited track history is what still bothers me. It holds me back from really getting on the TDAQ bandwagon. But for aggressive income satellite position, man, this thing you can't beat. The high yield's doing a phenomenal job. Now remember, I say every dollar needs a job. You need to match the right fund to the right role, not just yield. Not just put all your money in the highest yield and we're done. You need to look at the total package of how to fit this. So give you my final verdict, and I'll explain to you how I personally use this in my portfolio. And if you haven't seen my video on my 3-bucket portfolio for retirement, you really need to watch that. It gives you a lot of information. So I use this. GPIQ goes into my growth bucket. I know that one throws a lot of people for a loop. But GPIQ actually goes into my growth bucket to generate as much possible growth as I can. And then I use the income on a separate basis as of. I can take that 9% and re-roll it and drip it back into the fund if I need even more growth. I can take that income, pull it out, and use it in my income portfolio. Or I can use that to go into the income portfolio to add to any particular fund to grow that even bigger. So it's an easy way to milk it through. But I'm really dialing that one all for the growth in my growth portfolio. Now, the best retirement income and tax efficiency is QQQI. That immediately goes in my income bucket. Okay, that is my income bucket, especially in my brokerage account. You can't beat that side of it. And now TAP Alpha, the TDAQ, actually went into my income fund as an add-on. I use TDAQ as an add-on so far. Until TDAQ proves to me that they are able to produce everything long-term, I just slowly keep adding a little bit into the fund just to get it where I want it to be. And then we'll take a look at next year. If it proves out year number 1, we'll keep adding that as a bigger satellite in the growth side of it, in the income bucket that I use. So growth, GPIQ. Now, if you're inside an IRA or a Roth fund, more power to you. GPIQ definitely hits the home run and lets you run with it. And TDAQ could actually be the satellite to that fund. The QQI, you don't get all the advantages. I'd actually see it more into the GPIQ side of it. But there's 5 questions every investor should ask before you buy into any fund. What is the total return? Yield alone tells you absolutely nothing. It tells you basically, I'll call it half the story. But that yield changes. All those yield numbers can change by the minute. If the price goes up, the price goes down, your yield's going to go up or down. Normally it's the opposite. If your price goes up, your yield goes down. If the price goes down, your yield goes up. So that yield is just a moving target. You can't build long-term decisions off of. Is the NAV holding up? NAV erosion turns high yield into a trap. Is TDAQ holding its yield? Is it holding its NAV all the way through there? How is the income generated? Know the strategies. I explained the strategies of each one of these to you today, but you need to understand what is the actual strategy. Also, how is the tax working? Ordinary income, 60/40, ROC, they're all very, very different. And then what job is the fund doing? So nowhere do I say that one fund is lock in, you're done. Call it quits, winner, 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 chicken dinner. We're not there yet. Each one has a reason for where you're putting it, what portfolio you're putting it in. Are you looking for something for tax side of it? Okay, we can direct over here. That's why we have so many different funds. But you can't put the wrong fund in the wrong role. That creates real problems. Something I was always told in my business world, and that was you got to put the right people on the bus. And then when you get the right people on the bus, you got to put them in the right seat on the bus. Same thing here. Make sure you got the funds in the right spot. So the best income ETF is the one that delivers that sustainable income and a positive total return with NAV stability, tax efficiency, all four together. So which one does that fit? Well, I don't know everyone's situations, but I will tell you this. If you're into a brokerage account, QQQI's got to be right up there as number one. If you're in a Roth fund, if you're in an IRA, I got to put you at GPIQ is actually probably your number one. And don't be afraid. TDAQ, Tap Alpha, is on the hunt, and they're moving into place. Let me know your thoughts. Let me know which one you think is right. And tell me if you're using it in a brokerage account or if you're actually using it in a Roth or an IRA. I hope this helped you out. Please let me know. Leave a comment down below. I'd love to hear from you. Also, hit that like button. And if you're not part of the family, hey, what are you waiting for? Come on, join the group. And don't be afraid. Last call. Don't be afraid. Get our second round of those mugs. They're going quick. I'd love to just help out the channel. I believe those things are like $17. That's all they are. Let me know. We'll get back with you then. Thanks for watching.